September 2008. Before most people had even finished their morning coffee, Lehman Brothers was gone. Not weakened, not rescued, gone. By the end of that week, markets around the world were in freefall. Retirement accounts were shredded. Credit markets locked up. Banks stopped trusting banks. For ordinary investors, it felt like wealth was being erased in real time. But that is not what a crash really does. A crash does not erase wealth. It relocates it. It moves money from the unprepared to the positioned, from people who react late to people who understand the machinery underneath the panic. And every major crash in modern history has followed the same pattern. The headlines change, the trigger changes, the language changes, but the transfer mechanism does not. Most investors are taught the wrong lesson. They are told that when everything starts breaking, the goal is to hide, move to cash, buy a little gold, stop looking at your account, wait for the storm to pass. That sounds sensible. It also explains why so many people lose twice. They lose during the collapse, and then they lose again by missing the recovery because they are too traumatized to move. The investors who come out stronger do something else entirely. They understand that when fear hits the system, capital does not disappear. It runs. And it always runs toward a small set of assets that behave very differently from the ones most people own. March 2020. The world stopped, not slowly, not gradually. It stopped like someone had pulled a plug. Flights grounded, cities locked, markets went into freefall. In the span of 3 weeks, trillions of dollars vanished from global equity markets. Retirement accounts that people had spent decades building were suddenly worth half of what they had been worth a month earlier. The headlines were apocalyptic. Worst crash since the Great Depression. Markets in chaos. Is this the end of the bull run? And for most people watching their portfolios bleed, it certainly felt like destruction. Like wealth was being erased from existence. Like the money was simply disappearing into some kind of financial black hole. But here is what the headlines did not explain. That money did not disappear. It moved. It transferred from one set of hands to another, from people who were caught off guard to people who had been quietly preparing, from investors who panicked and sold at the worst possible moment to investors who understood what was actually happening underneath the chaos. This is the part of market crashes that almost never gets discussed in mainstream financial media. The part that separates people who recover quickly from people who spend years trying to get back to where they started. Crashes are not random acts of destruction. They are systematic transfers of wealth. And those transfers follow patterns that have repeated across every major financial crisis in modern history. The crash of 1929, the oil shock of 1973, the savings and loan crisis of the late 1980s, the dot-com implosion of 2000, the global financial crisis of 2008, the COVID panic of 2020. Once central bank intervention becomes massive enough to shift the conversation from deflation to inflation, that's why the people who really understand this asset do not treat it like a permanent religion. They treat it like a crisis instrument, a tool for a very specific phase of a very specific environment. If bonds are the quiet beneficiary of a panic, volatility is the loud one. Most retail investors only ever see volatility as a scary line on a chart labeled VIX. They're told it's the market's fear gauge, and that's usually where the explanation ends. Professionals see something very different. They see an asset class. In calm markets, volatility is cheap. Protection is cheap. Nobody wants to buy insurance when every dip gets bought and every setback is followed by a new high. Complacency builds. Risk gets underpriced, not because people are stupid, but because nothing bad has happened for a while. Hence something finally breaks. An unexpected default, a geopolitical shock, a pandemic. Suddenly everyone wants the same thing at once. Protection, put options, hedges, insurance. When that demand hits the market, volatility doesn't climb politely, it detonates. That's exactly what happened in early 2020. The market went from record calm to deep stress in a matter of weeks. Measures of volatility jumped to crisis levels. Products linked to short-term volatility futures went vertical. Correctly timed volatility positions were up several 100%. That is the kind of asymmetry that almost never exists in ordinary assets. So why don't most advisors even bring it up? Because volatility products are dangerous if you misunderstand them. In quiet markets, many of them bleed value slowly. Their structure means they lose money over time if there is no major shock. They're not designed to sit in a long-term retirement account. They're designed to be held tactically for a short and very specific window. Institutional players understand this. Hedge funds routinely use volatility to hedge their equity books. Some funds specialize in trading it outright. They know exactly what they're buying and exactly when they'll get out. Retail investors, by contrast, are usually never told they can own fear instead of just experiencing it. Distressed debt. Nobody is posting motivational quotes about distressed credit on social media. It isn't glamorous, it's technical, it's slow, but in almost every major crisis, it has quietly produced some of the best returns. Here's the mechanism. In a violent sell-off, many large institutions become forced sellers. A bank needs to raise capital. A hedge fund is hit with redemptions. An insurance company runs into regulatory pressure. They don't sell an asset because they've calmly decided it's worthless. They sell because they must raise cash now. And when you must have cash now, you accept prices you never would in normal times. Entire sectors can be priced as if mass default is inevitable. That's when patient capital steps in. After the 2008 crisis, sophisticated investors were buying mortgage-related securities and corporate bonds for a fraction of face value. Many of those securities eventually paid out at far higher levels. During the COVID panic, high-yield bonds were punished as if corporate America was going to collapse wholesale. When that didn't happen, prices rebounded sharply. Distressed investing isn't easy. You need to understand capital structures, legal priority, and default cycles. But the core idea is simple. Panic sellers push prices far below realistic recovery value. If you can buy at those prices and wait, you're not betting on perfection. Stocks get the attention. In a crisis, credit often gets the edge. From here, we move to an asset almost everyone thinks they understand, but almost nobody times correctly. Ask a casual investor what gold does in a crisis, and they'll give you the standard line. It sounds obvious, it's repeated constantly, and it's only half true. Because in the first phase of a serious crash, gold can fall right alongside everything else. Why? Because when margin calls hit and investors are desperate, they don't sell what fits a textbook narrative. They sell what's liquid. Gold is liquid, so it gets thrown overboard with the rest. That's where most people stop. And that's exactly where gold's real role actually begins. Gold's true power doesn't usually show up in week one of a market crash. It shows up in the months and years that follow, when governments and central banks try to fix the damage. After the panic, the rescue begins. Rates get slashed to zero or below. Quantitative easing programs appear. Trillions of new currency units are created and injected into the system. Central bank balance sheets balloon to sizes nobody would have believed a decade earlier. In plain language, the supply of money explodes. When the supply of something grows that fast, its long-term purchasing power erodes. People may not feel it immediately, but structurally, each unit of currency is slowly worth less. Gold can't be printed. It doesn't care about policy meetings. That's why historically gold's biggest bull runs have often come after crises. The mistake is expecting it to protect you during the initial fire. Its real job is to protect you from the flood of water poured on afterward. Finally, there is an asset that sits almost outside the financial system: agricultural land. Most investors hear real estate and think homes, apartments, offices, shopping centers. Those depend on tenants, jobs, and credit. Their value swings with the business cycle. Farmland is different. It exists to grow food. And people do not stop eating in a recession. A productive field will keep generating crops whether the stock market is booming or crashing. Its value is tied to biological cycles and food demand, not quarterly earnings or IPO headlines. That's why in several past crises, farmland has held its value and in some regions even appreciated, while residential and commercial property struggled. The usefulness of the land didn't change just because financial markets were having a breakdown. Of course, farmland has risks: weather, politics, water. But in a stable country, well-managed agricultural land is one of the most durable forms of wealth that exists. It does not need a bull market. It just needs people to keep eating. Put all of this together and a pattern appears. In every crash, wealth doesn't vanish. It moves. Every crisis is called unthinkable by the people it destroys, and familiar by the people who studied what came before. The real divide isn't luck or genius, it's preparation. The next crash will come. The timing is unknown. The fact of it is not. The only real question is, when that next transfer of wealth begins, will you be stuck watching your balance shrink? Or will you already know where the money's going to go?